How's everybody doing? Okay, I want to ask you guys a quick question so I know who I'm talking to. How many of you are founders or CEOs? Awesome. How many of you have raised less than $1 million so far? Good. We got an early stage group. That works out well because that's what I was planning on talking about. So this, by the way, I'm not texting. I made some notes. So this is sort of what Dave was talking about. Tradesy launched in late 2012. And this is summarizing kind of our yearly growth. There were definitely ups and downs in there. It wasn't all a straight vertical shot, but we've been growing nicely. In late 2012, we were 5 people bootstrapping it in my living room. Today we're 100 people with investors like Kleiner Perkins and Richard Branson, and it's been a really wild ride. So I also remember a couple of years back coming to these conferences and looking at these charts, because everybody's got charts that go up and to the right, and thinking, the people on the stage have some kind of like magic dust that I don't have, and how am I ever going to get there? And so I decided to share with you guys the real story of how we got there, which this chart goes back to 2009 and reflects 3 years in which I was experimenting, learning, growing, and focusing almost entirely on marketing, which is often what you have to do if you're an early stage founder or CEO. Like Dave was saying in the intro here, coding and design, all important stuff, but if you can't get growth, you can't get capital. And if you can't get capital, you can't survive, because the only reason that a company ever goes out of business is because it runs out of money, right? So getting that user growth should be your focus as an early stage CEO. And for me, I outsourced all the other stuff in the beginning. I outsourced design, I outsourced development, but I focused completely on the marketing. And this chart now looks super flat in those first 3 years because everything that came after was much bigger. But I did drive our early business to profitability using the techniques that I'm going to show you. So just a little background. In 2009, I launched a website called recycledbride.com. Funny name. Fun experience. It was a peer-to-peer marketplace for anything wedding related, mostly women buying and selling pre-owned wedding dresses. It was during the downturn in the economy and everybody still wanted a princess dress but couldn't afford it. So we had a really nice zone to pop into there. I later realized that the marketplace dynamics and the growth techniques that had been established on that peer-to-peer marketplace for weddings could also be applied to a lot of much larger categories, particularly where women are the primary customer. And so I went on in 2012 to raise our first round of financing. It was $1.5 million, put together a small team, and launched the same kind of peer-to-peer marketplace, but just in the fashion category now. And like Dave said, he was the first to commit to our seed round. He gave me $50,000 and said, I hate your deck, but I love you. I think this is going to work. And without that commitment, we wouldn't have gotten the investor that followed and the investor that followed that. So thank you, Dave, for believing when really nobody believed. And so if you're in the same situation, it doesn't mean nobody ever will believe. It just means that you got to hustle until you have numbers to put up on the board. So this is the method that I used early on to manage all of my marketing as a single founder with no team, and specifically no marketing team. And it's a really simple process. First, you want to identify really good opportunities. We'll talk about how to do that. Stack them up, evaluate them for both ease and speed and potential upside. Test a few at a time that you think have great potential. Throw away the ones that don't work, exploit the ones that did, and then start automating, which means handing off that channel to someone else so that you can go out and conquer new channels. I know this is stuff that has been spoken about today a bit. I think what we're going to go through here is going to be super drastically simplified, which for me would have been useful at that stage. I couldn't understand all the acronyms and all the formulas. I just wanted to know how, like, where do I put all this energy that I have to make this thing grow that's going to be most effective? And so that's what I'm kind of trying to get at for you guys here today. So the first stage of this method is to identify channels that you want to explore. And the way I think of channels is mature and emerging. And you'll notice that there are mature channels posted here, like Google SEM. These are very heavily populated marketing and distribution channels that everybody knows about. And then there are new and emerging opportunities, like podcasts are exploding in popularity right now. We think that's interesting and that it has greater potential to grow. We want to get in on the ground floor. But you might also think it's funny that under new and emerging channels, I've put TV commercials and direct mail marketing. Those are things that have been around since like the Stone Age, since before most of you were born. And the reason that those are categorized as new and emerging is because they're underpopulated and ignored. So here's kind of the concept behind why a new and emerging channel is so much better than an established channel. An established channel is already calibrated, the costs are already calibrated to the lifetime value of a customer for your biggest competitor. So I can break that down with an example from what we do. Let's just say that we're targeting women who want fashion, and we compete with the likes of big companies like Nordstrom, who probably have a 30 to 40% margin. They've been in business for so long that they understand what a customer is worth. They buy in bulk and they get discounts. Well, I'm competing for the same customer on a 10% margin with no brand recognition against costs that are already benchmarked against the biggest competitors in the market. So it's not to say that you shouldn't use established channels like Google SEM, like Facebook advertising. They're good distribution channels and they should be a part of your strategy. But where you're really going to see the massive upside is on new and emerging channels because the costs are lower. And when the costs are lower, your return can be higher. So how do you figure out what's a new channel and an emerging channel, and then what's a good opportunity and which one you should tackle first? I have dramatically simplified the thought process here. So first of all, look at hopefully by now you've made a list, all the channels, all the potential opportunities where you want to go. And the way that I like to think about it is that there are only two things that really matter about those channels. What will they cost you? That means, is it hard? Is it resource intensive? Or is it expensive? Remember that time and money are equivalent things. And when you don't have a lot of funding, it feels like money is more important, but your time is your only resource when you're starting. It is everything. So if you spend a chunk of time on a channel that isn't very promising, that you could have figured out from day one, didn't have the kind of upside that you really need to move your business because you didn't go through an exercise like this, that's an opportunity cost, and you've lost that time, and that's all you've got. So this may be the most important part of the process, just figuring out where you're going to put your time and energy. So I like to think of it on a scale of 1 to 10. How easy is it? And then on a scale of 1 to 10, what is the potential upside? And the potential upside relates to that kind of, is it new and emerging? Can you get really good prices? Might you get an exclusive with that channel so that your competitors can't get the same prices as you as that channel matures? Ways to find these things are really, to get the color you need to make these decisions, is to talk to people, talk to other CEOs and founders who are just one stage ahead of you about what they're seeing in the market and what they think the next big opportunity is, and then do your research and do your diligence. So here you can see, I'll use the podcast advertising as an example here because it got the highest score within this framework. So level of ease and affordability. Well, all you got to do is an audio recording, right? That's a couple $100, and you can do 50 iterations of it in one day with a voiceover artist. So you've got plenty of fuel to test, and it's a low-cost way to produce a creative that you can then distribute. I give it a 5 for potential upside because I see that it's a growing market. So I see that it's, right there I noted the inflection point with Pinterest marketing where everybody started thinking about it, and then it became very crowded and difficult to get any traction on Pinterest, at least for us. It feels to us like maybe podcasts are in that point right now, and that if we can get in with some of the biggest providers in that channel, make sure that we're locked in at a rate and that we grow with them, it has a lot of potential upside. So I gave it a 5 on potential upside because I think it's a growing channel and that's exciting, but I'm not sure that the entire population of the world will ever listen to podcasts. So maybe the market size is somewhat limited. And then this gives you a framework for deciding how to prioritize the things you want to go after. Again, it's dramatically simplified. You can see Snapchat marketing got a 4 here, but if you've got a market that you think is going to be flocking to Snapchat and is super engaged on Snapchat, then your scores will be different than mine. So these scores will always be unique to every individual business. Okay, so now you've decided, you found a few channels that have great potential upside and that aren't going to cost you too much relative to what they could ultimately produce. Now what do you do? So you'll hear a million acronyms around marketing about the things you should be measuring and looking at. And a lot of those things happen after the customers hit the site. Like we were hearing in the last talk, you know, there's a whole other side of this, but I'm talking about going out and getting the customer to your site. And in order to do that and to focus on that, there are 3 KPIs you need to track and nothing else. Your cost per click, your cost per lead. Lead is a sign up. Most of us have kind of a free sign up mechanism, a way for people to get on our mailing list, which means we can market to them more. That's valuable, that's a lead. And then a CPA, which is your cost per acquisition, which is how much it costs you to get a person to get out of checkout, to convert, to buy, whatever the end goal is for your business. And the one that's going to matter most for most of your channels, assuming everyone's going through the same conversion funnel, is that cost per click. And you can just see, I think you guys know enough that I don't have to really explain this, but you can see how the difference in a cost per click kind of radiates through your funnel and can make the difference between a channel that's a raging success as far as what that customer costs you versus a channel that's a terrible failure where you wasted your time, which is what we're trying to avoid. So, hold on, I have the clicker. Okay. Do you guys want to do this formula? Me neither. And luckily, we don't have to, because that formula is stupid until you have millions of customers and at least 3 years in. And I'll tell you guys, this was like the bane of my existence when I was fundraising, because every investor wants to understand LTV. And it's super important, but you simply cannot know in your first year or 2 what it's going to be. If we look at our cohort data, which is how you do an LTV analysis once you're mature, for year 1, it would tell us that we had like a terrible lifetime value, but it's actually turned out that it's fantastic. So I think what's much better than LTV to pay attention to in the early stages is just how long it takes you to make back whatever you spent to acquire that customer. And you'll see that referred to as like a CAC LTV formula. So it's like a customer acquisition cost versus a lifetime value. Just focus on your payback period on that customer acquisition cost, not on the lifetime value of what those customers are going to do over the following 36 months, because that's very hard to predict. You can make some educated guesses, but you really want to know, if I spent $100 to acquire a customer, what was my net revenue from their first purchase? What is the likelihood that they're going to purchase again times that same base net revenue? And then the likelihood that they're going to purchase again times that same base net revenue. And eventually you get to a point where your cost per acquisition equals the amount that you are getting back from a customer, and that is your payback period. So when you go out and you pitch for Series C or Series A and investors ask you about your LTV, I would just look at them and go, oh, we both know it's too early to tell, but let me tell you about my payback period, because that's promising. That indicates that as long as we get the product right and people continue to engage, that we're going to make a multiple on our cost of acquisition in the future. I still hate this formula, but we do use it now. This seems like it was covered a bunch in the bits of the talks I heard earlier, so I'm not going to go too deeply into it, but I'll talk to you guys about it from the CEO perspective. When you test, you'll draw conclusions. And the conclusions that you draw from testing over time when your business grows will become institutionalized knowledge that everyone on your team and that invests in you and that works with you will take as fact and base their decisions on. So there is no excuse for lazy testing, and it is your job as CEO to uphold incredibly rigorous standards for testing. And I only have 5 minutes, so I won't get into what those standards are, but I think that you guys heard it. And I just want to tell you from the CEO point of view, this has been one of my greatest lessons is watching early tests I did that produced misleading results, like false negatives, inform my team in the wrong direction. And now I'm like a monster about testing processes because it is so dangerous to get bad information and then have it kind of permeate through your organization. Even if your organization is an organization of one, it won't be forever. Whatever you think about your business is going to affect how it grows. So this is a perfect example. I thought that display banner ads didn't work for us because I did a bunch of testing myself and the results were miserable. We had like a $200 cost per acquisition, which was way above our benchmark. Later, when I had a really much better creative director than I ever was, and she put together some new creatives, we found out that that was in fact a great channel for us. But I made my team miss an opportunity for almost a year because I told them that Google Display didn't work. And I believed that based on a test that wasn't fully thought out. So that kind of like thoughtfulness graph from the last presentation, super important. Okay, I'm going to tell you what it was like. Actually, I'm going to skip this and come back to it. So then, once you've been testing a few channels that you believe have great upside and that you believe will be manageable for you to test, you got to figure out how to make them more valuable. So you've got a few that are working, a few that aren't. Throw away the ones that aren't working. And for the ones that are working, figure out a way to make it at least 25% more valuable. Great example from kind of early days for me was that we started doing a bunch of PR. Dave was saying I'm always on TV. It's not because I like to be, it's because it drives profit for our business. And I found that TV was driving a lot of traffic for us in the early days. But then I learned that if we distributed all of those TV PR moments across our social networks and to our partners, it also drove increased engagement from our existing customers who were kind of cheering us on and thrilled to see us on television. And also, it's validating when the media says this is a new thing you should use, and it reminds your existing customers to come back. So we got more than 25% extra out of it just from thinking about distributing the PR to our existing audience. Now when you've got channels working, you want to productize them. That means go back to when you started, break down your thought process, write it all out in a way that you could hand it to a 5-year-old and they could take it and continue to do what you've been doing, which is not to say that who you hand it to will be a 5-year-old. It's to say that you want to hand it off and you want to be able to go and conquer again. So this is the stage at which now you've got mature channels that are starting to really work for you. You should have perhaps a bit of funding, and you can hire an agency or an amazing person to take on what you have already established as a great channel. I'm so short on time. Okay, so back in 2011, this is what my marketing stack looked like. So as one person, I was able to do this method for multiple channels because I knew that I would only test 3 things at once. And I only had 3 things kind of working and being optimized, and I was evaluating the next stuff. And always, every time something moved up the chain, I would replace it with something new. And as long as you keep it, because it's very overwhelming, there's so many ways to grow. As long as you kind of keep it in these buckets and understand what you're doing where at what time, then it works out much better than if you kind of flounder around. It also reminds you about follow through. I have 1 minute. So this is what our marketing stack looks like now, and it actually wouldn't all fit on here. There's much more. But we're now at the stage where we have 9 people on our marketing team. Our VP marketing, Chris Nella, is a wizard, doing better than I ever could at many of these things. And we are constantly moving channels through this cycle. And sometimes they get dropped and then they get reintroduced with a new kind of view or technique. But this is a really simple way to go from going it on your own to building out a team and knowing where you should be paying attention when it comes to early stage growth marketing. Any questions? Okay, thank you.